So if we've chosen and or identified apartments as our product type that we're going to go after, now we need to look at, okay, well, how does this particular building that we're looking at, we've identified a property, how does this property fit into our investment plan, okay? What makes it a good deal, what makes it a bad deal? So what are some of the things we look at? First thing that we look at is cash flow, okay? Does the property yield the necessary rate of return to justify your capital investment, okay? The cash flow, the cash on cash return. The NOI details, the NOI stands for net operating income, okay? The details around that. So when we're looking at a property or we're evaluating the property, we want to make sure that we know what the NOI is now, what it has a chance to be in the future, and how did it get to where it is now? Very critical. Also, obviously, the price, very important. The cap rate. The cap rate stands for capitalization rate. I'll go into a couple of slides later, I'll go into what that is, how to calculate that. But that's just an economic measure that evaluates the cash flow of a particular property. Very, very critical. The rent roll. Rent roll is going to tell you what, how many tenants you have occupied in the property, how much rent that tenant pays, when they moved in, when their scheduled move out is, okay? If they're on month to month, if they have a balance, they owe some money in their rent. All this is very critical. That's contained in the rent roll. The last thing we're looking at is the cash on cash return. That relates to the cash flow. That number is a measure based on how much capital you invest into the property. That dollar amount is calculated by your down payment, but it's not only your down payment. It's your down payment plus your closing costs. Anybody ever got surprised by closing costs at the close of escrow? Okay, that happens, right? So you want to try to budget your closing costs and any other. If you go into a project and you plan to make capital improvements up front, that means you're going to put some money into the property. You want to budget that into your initial investment. Okay, the initial investment, as it relates to the amount of annual cash flow that you put in your pocket, that generates your cash on cash return. I'll explain on how to calculate that later. But these things are critical. This was what we're looking at when we're evaluating a property for ourselves to acquire. What we're looking at when we're evaluating a property for clients, whether they're buying a property or whether they're selling a property. Key indicators. All right, let's start with the income, all right? So when we're looking at a property, first thing we want to do is evaluate the income. We want to get to that cash flow, right? We want to evaluate the NOI details. So let's start with the top. First thing is income, right? So we start with our gross scheduled rents, all right? The gross scheduled rents is, we get there by taking our rent roll, right? And looking at what if every unit in our apartment complex, if they paid rent, all of them, and if all of them were occupied. So everything is occupied, everybody's paying. Okay, this is probably on a perfect world. But this is our top line number when we're doing our evaluation. That's our gross scheduled rent. That's the best possible scenario. Then what we do is we start taking away from that number, okay? We take away from that number with the vacancy factor. Every market, every sub-market is a market within a market. East Oakland, the Lake, North Oakland, downtown, those are sub-markets. Every market and every sub-market has a vacancy factor, okay? So I can tell you for the city of Oakland right now, that vacancy factor is in between 4 and 4.5%. Some areas in Oakland, a property that I'll talk about later, that's by the lake. By the lake, properties have more of like a 1 to 2% vacancy factor. Very, very low vacancy. If you go into deep East Oakland, you might see, as I'm talking about the 60, 70, 80, 90 avenues, you may see vacancy between 5 and 7%. But still very low vacancy relative to the rest of California. Now, in San Francisco, I don't know what the vacancy rate, I don't work in the San Francisco market too much, but I can tell you that there's very little, if not almost any vacancy on apartment buildings in San Francisco. That's why so many people from San Francisco are moving right here. This building is, there's 45 residential condos upstairs. About 80 to 90% of people who bought those condos and live here are all from the city. Because it makes a lot of sense. They can walk to the BART station and be to San Francisco in 10, 15 minutes. So vacancy is very, very critical. And you need to budget that in when you start with your gross schedule rents and then you budget your vacancy. Something that a lot of people miss with their analysis is loss to lease / concessions, and also in that category is collections. Okay, so people don't pay their rent. Right? How many people got an apartment building and not everybody paid their rent? right? That's just part of life, right? So we need to budget that in, we need to be prepared for that, all right? So we start with our growth schedule rents, we take away from that vacancy, we take away from that loss to lease, concessions. Concessions, let me just say, if you're offering the first month free, if you're in the soft rental market, not a lot of people do that anymore, but if you do, that's a concession, okay? Loss to lease, people moving out, people moving in, collection factors, people not paying, and that will happen, okay? You want to screen your tenants, you want to do the best you can, but the reality of, at some point in time, somebody is not going to pay, right? Then that gets us to other income. So we take those, we take vacancy, we take loss to lease, concessions away from our growth schedule rent, but then we add to it. We add to it by other income. It's a category of income that is not generated from the rent. So that's going to be laundry. That's going to be cable contracts. If you have a large enough complex, that's going to be billboards. Some properties around here downtown in heavy traffic areas have billboards with companies. It's just any way of income that you can generate on the property that is not rental.